Hi guys, thanks for tuning in to another episode of Nuggets News. We've got a very special guest back today, and that is Brent Johnson. We're going to be talking all about the dollar milkshake theory. Obviously, the dollar's gone a lot lower since we last spoke, and I know that people love to poke fun at Brent, saying, are you wrong? Have you changed your thesis? And I was saying to him in the pre-interview, I'm very used to that when Bitcoin falls 80%, and people say, you were wrong. So plenty to dive into today, Brent, but thanks for joining us again.
Thanks. Yeah, I'm happy to be here, and I'm looking forward to talking to you guys.
So I guess to start off with, it's been a few months. The dollar was around 100 on the Dixie index, and now it's fallen around, 7-8% at some stages.
Yep.
Has anything changed in your thesis?
Not really. I mean, I've said for a long time, a year or so ago, I was saying this is a 3 or 4 year play, and now I'm saying it's it's another couple of years. I don't have a crystal ball. I don't know exactly the timing of how this is going to play out. All I know is nothing has changed other than price. The fundamental reasons that I've laid out many times are still there. I still think all of them hold. And, the fact is that there's still an incredible demand for dollars. It's just been delayed due to COVID. And when the markets open back up and when people actually have to start paying for their houses and their rent and the inventory that they've ordered, that dollar demand is going to come back. Now, what happens in the meantime, I don't know, but I'm more than happy to keep my positioning.
Yeah, so I think for our majority crypto audience, it's very, very similar to the fact that people, laugh at Bitcoin and when it's falling and saying, haha, you were wrong. But as soon as the fundamentals kick in, we don't know if that's going to be 6 months or a 2 year bear market. Yeah. Once the trillions of dollars turn, then it's going to see a strong rally, and that's ultimately what we believe about Bitcoin as well. So what have been the main catalysts for the recent temporary weakness? You do think it is the fact that global economy that has the demand for dollars when there's more of a velocity of money has slowed down because of COVID, and we're seeing delinquencies, delays in bills, all those things that are paid in dollars. There's just that less demand.
Yeah. Well, I think it's a combination of things. So what we missed in the spring, and listen, when the day that the dollar hit its high, I even sent out an email saying, or a tweet saying, hey, the central banks are going to do something. The Fed's going to come out. They're going to institute a program and they're going to whack the dollar. I said, I don't know when they're going to do it, but they're going to do it and it's going to hurt. And they basically did it the next day, right? Now, we didn't think it was going to fall 7%. We thought it might fall 4 or 5%, but it's fallen 7%. So, but the thing that we missed is, it's not the central bank reaction. We knew that they would do something. What we probably should have anticipated better was the deferment of demand. And what I mean by that was the level to which people didn't have to pay their rents. People didn't have to pay their mortgages. If they financed inventory, they didn't have to pay for the inventory within 30 or 60 days. That got put off for 90 days, 180 days, or whatever it was. Now we think and at the same time that happened, the central banks came out and did more QE. The governments did fiscal stimulus, and so all that combined, has basically, it hasn't changed the demand for dollars. It's just delayed it. If everything's ever go back to normal, we think that the demand returns. Now, if you think that the governments can just spend forever and there's no adverse effects, and that the monetary authorities have everything under control, then maybe the dollar stays lower. I don't think they have everything under control. I think that there will be unintended consequences of everything that they've done, and I have no doubt in my mind that when this all plays out, the dollar is going to be much higher. Now, whether that's next week or next year, I don't have that crystal ball. Yeah. Like I said before, this is the 2 or 3 year play for me. If it happens in the next 2 or 3 months, great. If it happens in the next 2 or 3 years, that's fine too.
Yeah, I mean, you say you should have seen the deferment a little bit more, but I'd probably disagree. Like, most commentators were saying this is going to be a 3 to 6 months COVID bridge to the other side. A lot of people saying all the world's smartest minds are working on a vaccine, so it'll be faster than ever. So I think a lot of people, if you said what would be happening in September, Victoria and Melbourne, stage 4 lockdown still, people would not have thought that. So look, in terms of COVID, do you have just any broad thoughts? Because I know my personal opinion as a pharmacist, I was very, very worried to begin with when we were seeing the Italys and the New Yorks. But now I'm sort of leaning more towards, well, we need to start asking why Sweden haven't got it that bad and they didn't go down that hard lockdown face mask route. And there's a lot of data saying that this is a bad disease when you get it, and it has inflammatory components. It's not just a respiratory disease. But I think the truth is somewhere in the middle, and it worries me that Melbourne's in stage 4 lockdown and saying we're not going to open up until we get under 10 cases. I mean, that's just crazy.
Yeah, I mean, listen, I'm not one of these people who say that COVID doesn't exist and it's a complete hoax. But I also think that the way it was handled was probably not the best way, and it probably could have been done better. I don't think they needed to shut the whole global economy down. But and I'm not diminishing the seriousness of it. I'm just saying that places like Sweden seem to do okay. Now it doesn't mean that they're. Maybe they will have some adverse effects, and it's sad for the people who did get sick there. But at the end of the day, there's not been a whole lot of studies done of the damaging effects of the lockdown. How many people are out of work? How many people have lost their businesses? How many people are going to go hungry and die because of that? That doesn't get talked about as much as the other part of it. And I'm not sitting here claiming that I have all the right answers, but it's quite amazing. What has happened over the last call it 6 to 9 months.
Yeah.
And I think it has been overdone personally.
In Australia, we are seeing like hundreds of doctors now sign these letters saying we need to be talking about the mental health and the other side of things.
Yeah.
And that's why I was an advocate of go hard early, go to complete lockdown for 4 weeks and stamp it out. Like New Zealand did that fairly well. And here we are just dragging on. And the truth is somewhere in the middle. We don't want another repeat of Italy or New York, but we also want to find out why certain people didn't get it so bad. But the
interesting, the one thing I'd add on to it is, the way I would have preferred that it was handled was not handled that way, and that's not something that I get to decide, right? But I would say that there's enough, let's call them just powerful people in the world that now almost have a vested interest in having a second wave or having it being as serious as they initially said. Because when you consider the damage done by the lockdown, I mean, they've put, people out of work, whole industries under pressure. If suddenly the virus disappeared and there was no second wave, that would not look too good for them. And so regardless of whether COVID was never serious or is even more serious than they thought, my point is that the powers that be, they kind of need a second wave. And I hate to say that because I know it sounds conspiratorially, but I do kind of feel like they need a second wave.
Okay. Yeah, no, that is interesting to hear you say that. The thing that I get frustrated about is if you're going to tell people like tourism industry, you're out of work. Tourism in Australia is so important, and now we've got this relationship with China as well, and all these things that seem to be cratering around us. And yet, you're going to tell those people that no, we're not going to extend JobKeeper, and you've got all these casual staff or whatever in the tourism industry or service sector, and you're just going to cut them off. That's the thing that really frustrates me, that we're approaching this fiscal cliff or whatever they want to call it. And places like Australia that don't have huge deficits are still hesitant. And that's probably the next thing I want to talk to about Australia, whose currency has strengthened. This is a great example of the relevancy of the currency arguments and the cleanest dirty shirt in the laundry. And if you had said to someone that Aussie dollar is going to rally 30% in 6 months, and we're still in stage 4 lockdown, and we're in such bad shape in terms of our economy and the structural pieces there. But that is really important for people to understand that differences about it's all relative. If you're going to tell me the dollar's going to zero, like what against? Yeah,
it's pretty incredible. I mean, I think at the beginning of the year, the Aussie dollar was around 68 or 69. It went all the way down to 50. And don't forget that, like it went to 55 over a couple week period, right? Yeah. I mean, that's a heck of a fall. And then the rebound on top of it, now we're at 72 or what are we at 72, 73? Yeah. And so it's been incredible, both to the downside and back to the upside. Now, I haven't changed my opinion. I still think that, the Aussie dollar is going to have a lot of troubles over the next couple of years. But, anybody who bought that dip on the Aussie dollar, they're probably feeling pretty smart right now. Kudos to them. That was a good trade.
We did a video that day saying this is like a retail capitulation, because our inbox was lighting up with how do I buy dollars? And it was saying, guys, this is the the inbox lighting up with how do I buy Bitcoin when it goes parabolic and it's at $20,000. It was the same thing. And now we've seen that rebound. But I do think that fundamentally it has to roll over at some point. One of the things the RBA did was be very defensive in terms of all the global central banks and their actions. And just this week, they've committed another $200 billion, which is maybe the equivalent of, say, 2 or 3 trillion of the Fed in terms of an equivalent size, well, at least by population. But one of the things I was saying was they're too defensive. The Aussie dollar is going to strengthen and they're going to be caught out here and they're going to have to do something. So do you think that all these central bankers have got together and said, look, we kind of do need the dollar to drift a bit lower? Because when the ECB, Christine Lagarde, comes out as well in the same week and says, things are okay, we're not going to rush to print more money or increase our programs or whatever. That's very different to every meeting where Draghi's saying whatever it takes, whatever it takes. We've got a new guy in Japan now, and I was just really surprised to see Australia and Philip Lowe come out and say $200 billion when he's been so defensive. So what do you think is going on there?
Well, I think they probably do talk. I mean, all these central bankers from around, they all go to the same schools, they all go to the same conferences, they all go to the Bank of International Settlements every couple months, and so there's definitely conversations between. I don't know if there's coordination, but there's definitely conversations. And the reality is that it's pretty funny because at the beginning of the year there was at 96, the dollar goes up 6%, and they have to set up, and everything is so bad, they're going to have to set up a new system because the dollar's too strong. And since then, it's down 6% or down 10% from the high, down 5 or 6% from where it started. And now the dollar's so weak, it's going to lose the global reserve status because it's too weak. I mean, that's a pretty narrow band that you have to stay within to keep the global reserve currency. So I kind of find that to be a little bit funny. But the reality is that, and this is kind of what my whole theory is based on, is that a really strong dollar doesn't help anybody. Right. And so there's no doubt in my mind that they will do things to try to counteract that. I just don't think they're going to be successful in doing it. So it's not shocking to me to see in the short term, the Royal Bank of Scotland, the Bank of Canada, the Bank of England, ECB, to come out and not exactly, kill their currencies with narrative right now. Because the weakening dollar over the last 6 months has certainly helped the world reflate from the COVID crisis. Now, I guess I would say what you would like to do over the next 2 or 3 years and what you'll actually be able to do over the next 2 or 3 years are two completely different things. I always use I've said this before, but I think it's a good analogy, is that I would very much like to be able to hit the golf ball like Phil Mickelson. Yeah. But my ability to do so is just, it's not reality. And the idea that Europe and Canada and Australia and China can let their currencies strengthen 10 or 20% as the dollar falls 10 or 20% and their export economies are going to be fine, I think is foolish, for lack of a better word. I just don't think that fundamentally works for them. So maybe in the short term, they're able to take a little bit of it on the chin, but I have no doubt when we get into Q4, Q1, Q2 of next year, it's going to, everybody talks about the printer go burr in the US. Well, it's going to be going worldwide. And there's just not as much demand around the world for these other currencies that there is for the dollar. So I think that's the difference. Everybody's going to print, but the dollar has more demand. Yes,
exactly. And I think it's also important to note that some of those top currencies, like we just spoke about, are doing okay against the dollar. But there's also the Turkeys of the world and some of these others that are already hurting. So let alone if we get the snapback rally in the dollar and all those emerging markets get crushed. That's where I think, well, what are they going to do? What are the conversations that they're going to have when we do get a snapback rally and everyone is really hurting? What do you think they can do? Or what, we've already seen in the past, people say it's not fair, but do you even think it's fair on America anymore? We're starting to hear talk about it's even a burden for them, and the eurodollar as it exists is almost a different currency to the domestic dollar market. It's almost bad for them as well.
Yeah, the eurodollar market is the key to it all, in my opinion. There is so much demand for dollars outside the United States. The eurodollar market, or the market for dollars outside the United States, is almost as big as the market for dollars inside the United States. And the market for dollars outside the United States is almost as big, if not bigger, than any other currency, both the domestic and international market for those currencies. And the fact is there's nobody that regulates that market. And there's nobody that can bail that market out if and when it needs to be done. Now, can the U.S. extend swap lines? Yes. But my point is this problem is so much bigger and the markets are so much bigger than anybody realizes. The Fed's going to have to print a heck of a lot more than $7 trillion to solve this problem. The Fed balance sheet, I've heard people say it's going to go to 10, 15, $20 trillion. It's going to go twice that much, and it still might not be enough. The problem is absolutely, and the other central banks' balance sheets are as well. It's the market is just so much bigger than people realize. It's going to be a mess. So I'm sorry, it's just going to be a mess.
So just to give people a better understanding of that, again, for the beginners at home, the eurodollar market is just the term we use for dollars outside of the United States when it's doing its world reserve currency thing. We've got 20 trillion, 26 trillion of debt in the US. We've got all these unfunded liabilities, but then what's the size of the eurodollar market? We don't really know, 10 or 20 trillion dollars sort of estimates. So when the Fed is saying they're and ahhing about committing the next $1 trillion, or the US government are running this $3 trillion deficit, and people saying, are the Fed going to monetize that $3 trillion? But out here, there's this $20 trillion debt gaping hole that needs dollars if it's ever going to be repaid by all these countries. So the Fed are kind of in that rock and a hard place. And I don't think they even realize it still. And this is where some of the other experts I listen to are getting frustrated, that the Fed need to have almost like one policy and course of actions for addressing that external market. Because even if they get out the fire hose and print $1 trillion or $3 trillion and people go, oh my God, $3 trillion, that's just still just such a small drop in the ocean of that external market. And they're almost just like every time it starts to collapse, it's just like just enough to keep it from getting really bad. Yeah. But to put the money out there into existence to actually get everything circulating, and like you said, it's just an unregulated market. And do you think they don't even realize the, seriousness of all that?
Well, I think at this point they realize it's there, but I think their hands are somewhat tied in their ability to fix it. I mean, there's really no transmission mechanism via which to fix it, even if they do. I mean, they don't have the authority. They don't have the jurisdiction. Theoretically, they can extend swap lines to Europe or Australia or China or whoever it is. But what you have to remember then is even if they do that, it doesn't fix the problem. Because all that does, it's not new money that's going to pay off these loans. It's new money that's being used as collateral to extend new loans that make the existing loans bigger. So even that doesn't solve the problem. And I guess that's my point with all this is going to end in a big deflationary spiral, right? And they are going to, the end game will be the inflation that comes after they have to print so much to counteract this massive deflation. But my point to everybody is they're going to have to print a lot more than they've already printed in order for that to happen, because the hole or the debts, the bad debts, are so much bigger than anybody realizes that I just don't think that they've done anywhere near enough yet. And so we're going to have these periods where we get reflation and deflation and reflation and deflation, and some of these countries, in order to get out of their deflationary spirals, they're going to have to print a lot of currency as well. But because there's no international demand for those currencies, they're going to experience higher rates of inflation than the core markets initially. And that's why I say it'll start on the external countries and it'll move to the core.
Well, I want to talk about the money printing in terms of how QE differs in, say, Turkey when they print money versus in America. And then I want to also talk about, that euro dollar market and how the swaps actually work. So the term QE and money printing, it's actually what people get confused about here is a lot of that is just going to the banks as reserves and topping up their reserves. So you can print as many trillion as you like, but if that is just topping up the reserves of the banks and they don't lend that out and get into circulation, then it doesn't really cause inflation. That's kind of what everyone missed when they thought there was going to be inflation 10 years ago. Is that right? Would you explain that?
That's absolutely right. That's absolutely right. They when they do QE, they credit the bank's accounts that sit at the Fed with reserves. Those reserves cannot be spent. Those reserves can be used as collateral for the banking system as a whole to generate new money, and then they can use that to lend. But if all you have to do is look at there's a report that the Fed puts out every week called the H8 report. And you go over to the far right column and it shows the extension of credit. And the reality is other than an initial spike in April, after, the initial stimulus plans and the initial QE programs, they've actually been tightening lending. They've been pulling back. So but one thing that, and this gets a little controversial, and a lot of people just don't believe it. But when I've said that QE I've actually said QE is deflationary, because what they're doing is they're actually pulling liquidity out of the system when they're buying these bonds. But it is inflationary. It has the potential to be inflationary if the banks lend. The banks aren't lending. So from that perspective, it's not. But the other way it's potentially inflationary is if it changed behaviors in consumers. And if the central banks come out and say, we are flooding the market with liquidity, and people believe that they're doing that, and the people then change their behavior, and the people go spend, and because they want to buy something before it gets higher, or they buy stocks because they think the Fed's going to pump liquidity in, or if they go borrow because they want to borrow low before this inflation hits, then it can be inflationary. But there has to be that follow on, right? And so you'll get these, and they'll announce QE, they'll announce these new packages. You'll get this initial bump out of it because everybody believes them this time, and then ultimately it fails and it rolls back over. And we've seen this for 12 years now. This is not a new phenomenon.
Is that what we've seen in the corporate bond market recently? I think it was a record like 50, 60 billion of issuance in August, and the Fed bought zero of that. And there's this huge appetite because people have this confidence game that the Fed will have their back. Is that the same sort of premise?
It's the exact same thing. And I'm glad you brought that up, because this is the corporate bond market is a perfect way to explain what I'm talking about. Because a lot of people say, Brent, you're crazy. It doesn't work that way. The banks are going out and buying stocks and pushing them higher. Well, the interesting thing is that, in March, or maybe it was end of March, beginning of April, the Fed came out and said, we're going to do these special purpose vehicles. And we're not only, going to buy government bonds, we're going to buy corporate bonds. And the next day, junk bonds took off and corporate bonds took off, and they went on a spectacular rally. Yes. And then it got into the middle of May, and Jeff Gundlach, one of the big fixed income manager, comes out and says, the Fed actually hasn't bought any bonds yet. And everybody's like, what do you mean they haven't bought any bonds yet? Yeah. Despite the fact that the prices were running up. And that's the point, is if you can change behavior, the Fed can change behavior, and that can affect the market without them actually buying anything. But then the Fed was like, oh yeah, I guess we actually do have to go buy those, right? Because he was basically calling their bluff. He's like, they're not even buying. Yeah. So then they did come out and buy, and they made that, I think they've bought in the last 6 months, like $400 billion worth of securities, which in the overall scope, it's not that much, right? Now, don't get me wrong. It's a step too far that they shouldn't be doing it. Yeah. They're eventually going to monetize everything, but right now they haven't. And to your point, they did it like in May and June, maybe a little bit in July, but in the last 2 months, I don't think they've bought anything.
No, and then
so they did that one purchase, and then it's just flatlined.
And again, it's almost like the companies that need that the most aren't really getting it, and it's the Apples of the world that have got hundreds of billions of dollars on their balance sheet that are borrowing capital almost for free and then buying back shares. And it's just this cycle of, I joke about the sausage machine, the economy, and the Fed keep pulling these levers and stuffing stuff in, and then they look at the sausages that are coming out going, why can't we get inflation, and why isn't the labor market getting better, this, that, and the other? And it's just everything about the structural setup and the financial system is just wrong to get to that endpoint that they're trying to get to. I want to continue on with where I was going with that train of thought, though, in terms of the QE that we've just explained, because, yes, I definitely agree. But one thing I want to hammer into there is that you cannot use those reserves to speculate. But when the repo market seized up and Jamie Dimon says, we got no money to lend, but we've been very busy buying bonds and we've got record profits, can you say that it's just robbing Peter to pay Paul? That dollar that would have had to be a reserve is now gets to go and speculate on stocks and...
Sure. And, so I'm not saying that QE doesn't have any effect on markets. It clearly has an effect on markets. The point I'm just making, though, is it doesn't work the way most people think it does.
Yes.
Does the Fed doing QE free up other money that the banks would have had to spend on something else? Of course. Okay. Yeah. If a bank does QE on behalf of one of their hedge fund clients and the hedge fund gets the cash, then that has inflationary tendencies. But primary dealer banks are not getting cash from the Fed and going out and buying Apple.
Yeah.
That is not the way that it works. So and at the end of the day, the Fed can build up their reserves, but if the banks don't lend, you are not going to see the velocity of money, and you're not going to see the runaway hyperinflations that everybody thinks that is going to happen. It just doesn't work that way. And I'm not saying that for people who have studied history and know that central banks will eventually print it all and it will lead to hyperinflation, I commend them for doing the research to understand that's what's going to happen. And that will eventually probably happen, but we're just not there yet. Yeah. And what is happening now is not what you think is happening now.
Yeah.
That's the important part.
Yeah, I did just want to clear that up, because I hear some very smart people saying, oh, you're wrong, they're just reserves so they can't spend it. But I do think that dollar for dollar argument is actually important to understand, because in some ways that can explain why some of the assets have been going up. But again, it doesn't really lead to inflation in the real economy. It can explain why we've had the assets on Wall Street perform so well. But let's dive into the bank swap. So how does that work for people at home? If I'm Australia and I'm in desperate need of dollars, do I have to swap Aussie dollars with them? Is this still putting strain on my currency? How does that work exactly?
Well, so to the extent that Australian corporates or high net worth individuals or whoever in Australia, if they need US dollars because they financed a transaction or inventory or real estate or whatever it was in dollars, and now that for whatever reason, but they earn in Aussie dollars or yuan or whatever they earn in, right? Now they got to swap those to get dollars. Now, but if the banks don't have the dollars to give them, then the banks go to the Royal Bank of Australia and say, hey, we need dollars. And if the Royal Bank of Australia doesn't, is it Royal Bank of Australia? Am I saying it right? That's what it's called, right?
The RBA, I think.
Or is it the Reserve Bank? It might be. I think it's the Reserve Bank.
Yeah, and I was thinking, no, it's the Reserve Bank of Australia. Yeah,
it's the Reserve Bank. I've made that mistake before, and somebody corrected me. So it's the Reserve Bank of Australia. If they don't have the dollars, then they've got to go to the U.S. Fed and say, "Hey, we need dollars." And the Fed will say, "Okay," because Australia is one of the countries that has a swap line, and so the Reserve Bank of Australia will print, quote unquote, Aussie dollars, pledge them as collateral to the Fed, and the Fed in exchange will give the Reserve Bank of Australia dollars. And then the Reserve Bank of Australia will go out to all their clients, typically the banks. I don't know. I'm not sure what the primary dealer banks are in Australia, but the equivalent.
Yeah.
And those banks, the big 4 or 5 banks would say, hey, we need this many dollars. And then the Reserve Bank would say, okay, we'll give you so many dollars. You need to repay us in anywhere typically from 2 weeks to, I think it's 18 weeks. Is it 18? I think it's 18 weeks. And so then, that will be a loan that's then extended to those corporates. But we're not just giving them the money, right? Because the Reserve Bank of Australia eventually has to give the dollars back to the U.S. And the Reserve Bank of Australia, they will then loan them out, right? But it's loans, and they're not just giving them to you and the Australian corporates.
Like people think about, I go on these crypto exchanges and I click a button that says swap Bitcoin to Ethereum and the transaction's done. The terminology swap is very different in that case.
It's very different. Right, exactly. They're loans that have to be repaid.
And how
then people will say, well, yeah, but they'll just extend them forever. Yeah, theoretically they'll extend them forever, but if they do that, the problem just gets bigger and bigger and bigger. That's what they're talking about, is if you just extend it forever. That's basically what all the countries of the world have been doing for the last 50 years since we went off the gold standard, right? But eventually it all comes crashing down. So yeah, will they extend it? Yeah, but the problem just gets bigger and bigger and bigger. Eventually it will collapse. And when that happens, the collateral underneath it goes up in value. And the collateral is dollars.
So that gets to the root of the problem that we're talking about, where they still need to repay it. And where do those dollars come from that are outside the US? And this is where will the Fed need to address that, but they're not really seeing that clearly, I don't think. So can Australia, can they choose to just print dollars to pay them down, or they have to actually pay back US dollars. They can't just say,
no, they have to pay off. Well, they could. Okay, so
at the exchange rate, and then the exchange rate falls.
Right. So theoretically, the Reserve Bank of Australia could print however many Australian dollars they need, go into the open market, buy dollars, and then give them back to the Fed. And this is exactly my point, is eventually that will happen. And when that happens, that will weaken the currencies that have swapped with dollars, right? Because you're printing more of your currency to buy dollars on the open market. That is how that's actually how you affect exchange rates, is you print your currency, and that's how pegs work. That's how currency pegs work. Yes. Is you print your currency and you buy the currency you're pegging against to artificially, set the price. You buy or sell it.
Who's providing the liquidity there, and why wouldn't the RBA go there in the first place and say, we've just printed X amount, 100 billions of Aussie dollars to go buy 400 billion US dollars rather than do a swap from the Fed? What's the mechanism there, and who's involved, and why wouldn't they do that in the first place?
Because it costs a lot more to get them from the market than to get them from the Federal Reserve.
Because there's not the
liquidity. Right. In April or in March, when everybody needed dollars, the dollar was going up in price in 102, and dollar funding was the price of dollar funding was rising. Okay. And even at those prices, it was hard to get the dollars that you needed.
So if everyone tried to do that and pay down their debts, that's when we would see the milkshake theory, like on steroids. Right. Okay,
that's right.
Let's maybe the final part of that example I want to give is let's say Russia don't have a swap line.
Yeah.
How do they get that demand for dollars if the Fed won't offer that to them? It's only external markets.
They would have to print their own currency to get it.
And this is what
they would have to go into the market to get it. And Turkey's a good example. Turkey has extreme needs for dollar funding, and they don't have a swap line, right? And so they've got to go to the market to get it. And as their currency has been, here's the problem: that their currency has been weakening, and so the Turkish central bank has actually taken the dollars that they do have and sold the dollars and purchased the lira in order to artificially strengthen the lira, because they don't want the lira to collapse. But the problem is they need those dollars, so they're draining their reserves, which their banking system needs in order to support the currency. So either the outlet's either going to be the banks or the currency, right? Yeah. So they're either going to have a banking crisis or the Turkish lira is going to fall, one of the two.
And this is where you get into this situation where Turkey and China and Russia and say, well, let's try and do these bilateral trade agreements and settle in gold, or Venezuela tries to settle in their cryptocurrency, because it's anything that pushes away and says we don't need those dollars. That's good if we can not be so reliant on dollars, basically.
Right. Yeah. And the thing with those bilateral and maybe trilateral and the different trade agreements going forward, we're going to use the yuan or the ruble or gold or whatever it is. That's fine going forward. But the legacy dollar debts still exist, right? That money is still owed. Like, for an example, both Spain and France have huge exposure to Turkey. The Spanish and French banks have big exposure of dollar loans to Turkey. If Turkey starts trading in rubles and yuan and gold and just defaults on those dollar debts that they owe, well, then that has knock-on effects for France and Spanish banking system.
Yeah.
Right. So it's not like you can just walk away from this stuff and there's no adverse effects. It's all interconnected. And, the idea that, everybody's just going to default on their dollar debt and it's not going to have any adverse effects and it's actually going to hurt the dollar, it just doesn't work that way.
So I want to dive into the world of digital currencies a little bit and see if this changes your thesis at all, because the way that I'm sort of thinking about this and joining the dots in my head is the new digital rails where everyone can have a smartphone and they download a crypto app and they can get hold of these stable coins, and we've got a spectrum of those. where there's the fully decentralized ones that we spoke about in the pre-interview, like the DAI, and that's a synthetic dollar, and I can actually mint that myself against a range of collateral, against a Bitcoin, or if I want to tokenize my house, or if my website address is valuable, anything that I can have as a token, I can lock up and mint synthetic dollars against it. And then we've got the spectrum of things like Tether, where it's a little bit shady about who their banking system is and if it's backed one for one. And then we've got USDC, which is like fully regulated, and I can still get my hands on that, even though it's a very US-centric thing. So where I'm sort of thinking is that, hey, if I'm in Russia or Turkey and I need a lot of dollars, I can now either by tokenizing things or minting my own collateral or selling assets, whatever it is, I can now swap those on an exchange and get some US dollar stablecoins, and I'm kind of protected. And if there's a huge demand, let's say that all these millions of people, billions of people around the world went that route to get dollars rather than through the banking system or relying on swaps or the Fed or anything, all of a sudden you'd have a huge demand from like stable coins, US dollar stable coins. But the people that are sort of issuing those are the US exchanges, which are right next to the US banks. And you're seeing my thinking process here, where they can say, hey, we've got trillions of dollars of demand and they need to borrow more US dollars, but it's very easy for them to borrow off the US commercial banks and the Fed just gives them more. So that's a new system which has this new web, and this instead of the milkshake theory, it's all these digital rails pinging around each other, but it all comes back to this digital home in America where it's very easy to expand the supply of dollars. So are you sort of following where I'm going there, and does that make sense? Or
well, I think so yes and no. I guess I understand what you're saying, and I do think that is happening, and I think it's going to happen even more. So I think that area is going to grow. I think it actually, while you're saying it increases the supply, it does sort of increase the supply, but it increases the demand at the same time. It's like a dollar loan. When a dollar loan gets extended, it is increasing the dollar supply, but that loan is demand for dollars in the future. At some point, that has to get paid back, right?
Well, I'm effectively selling whatever currency I'm in for dollars. So I'm not. That's not the thing I'm sort of getting at. It's more can that be a way to address the shortage rather than going through these external. I've got to rely on a swap, and then I've got to go to this domestic bank, and they've got to go up the food chain. I'm going directly to like a US crypto exchange, which has a bank in its back pocket, and that's the digital rail for me to get dollars.
Yeah, I think that is a way to access dollars, but at the end of the day, that bank still has to have the dollars to supply them, right? You can't, and if it's just done digitally and nobody ever calls in the collateral, because prices are rising, then it's like anything. When credit's being extended and asset prices are rising, everything's fine. But if we get into a situation where things are not rising, collateral does get called, and you actually need the dollars, I think you might actually end up with a situation where there's more claims on dollars than there's dollars to go around.
Well, let's forget even like the collateral side of things here. Let's just say that I'm selling assets and trying to get dollars, and in a way that I couldn't get dollars because I didn't have access to those in the country I'm in. You say that there still needs to be a supply of dollars. That's the kind of thing that I want to like drill down into. If Coinbase, who have just recently, Jamie Dimon and JP Morgan, who have spent years bashing them, have said, hey, we're going to start banking Coinbase. If Coinbase is saying, hey, we need $1 trillion, there's this huge demand for stablecoins this week, where do they get that $1 trillion from? And can they turn around to the Fed and say, hey, this is great. We need, they've been topping up our reserves. We've finally got people that want to borrow. Isn't that a much more efficient way of going up the food chain to get dollars to where they're needed almost around the world? Does that make sense?
Well, it does. But again, those dollars, if they're coming from JP Morgan to Coinbase, or even if they're coming from the Fed to JP Morgan to Coinbase,
yes,
they're not just being printed out of thin air and handed to Coinbase to go do whatever they want with them. It's some kind of an extension of credit or loan. JP Morgan is not just going to give Coinbase $1 billion. They may extend them $1 billion loan, and that may be backed, and they may extend them that loan by using the reserves that JP Morgan has at the Fed that they've gotten through QE. But again, it's still a claim on the reserves of the dollar, of the monetary base. again, everything, it's all money in our current system, at least, is loaned into existence, right? It is a pyramid scheme. It's pyramided off the base. And so I do think that exactly what you're talking about is another channel to get the dollars that exist.
Yeah.
And it's another way it's almost like a shadow bank, for lack of a better word.
Exactly.
Right. And so it's almost like the eurodollar market, right? It's getting, there's all these claims on dollars out there, and it's hard to measure. And, some of them are done by banks. Some of them are not really banks. Some of them are shadow banks. Some of them are brokerage firms. And now that we've got these, crypto assets and digital exchanges. And so it's all kind of that same world, right? And so I do agree that is listen, it's a growth area. That area is not going away. This is an area that's going to grow bigger, but I don't think it's just it's a way to just create dollars out of thin air that never have to be, that aren't a claim on the original monetary base.
No, it's definitely a claim somewhere. That's what I'm saying. It's
somewhere there's a claim, right?
And what I find so interesting is now that we've got synthetic Aussie dollars, synthetic euros, and everything, and we've got a really, really liquid markets, and these stable coins have grown from 1 billion to 10 billion, and I honestly think that they'll be at 100 billion in 12 months. It is growing that fast, and once you get into the trillion, then you start to say, hold on, this is serious competition for the forex markets. But in this world, we've got these automated market makers and all these incentives to create very, very liquid markets, and I actually think it's a far better system than the banking system and the shadow banking system and the SWIFT system where you're going all these hops to different banks in different countries. So if we get this system where it's deeply liquid markets where I can swap Aussie dollars to synthetic US dollars with basically no spread, then we go back to that equation. Well, wouldn't the RBA be better of going into these synthetic markets and just doing that swap, or can people go to these crypto synthetic markets to get these dollars? And again, it's far easier. There's less fees. It's just far better rails, and it's a shadow banking system, or however you want to think about it. But I just think it's going to obsolete the current swap lines of the current banking system.
Well, I think you're probably right. And I think this is going to kind of bleed into a whole other area. And I don't know if you want to talk about this or not, but I don't know if you know who Richard Werner is, but he's a So I mean, his theory for a long time is going to be that we're eventually going to have one or two banks in every country, and then it's eventually everybody's just going to have an account with the central bank of the country. And it's becoming, instead of decentralized in the real banking system, it's becoming more centralized, right? And then, and it becomes even easier for these central banks to do this if everybody has a digital wallet and you can distribute these coins digitally. So I think that we're going to have, to your point, it'll be more efficient for Reserve Bank of Australia to do this through these digital exchanges, right?
Yeah.
But there's also going to be a battle between centralized digital exchanges and decentralized digital exchanges, right? Because the central banks are going to want to have control.
100%.
The governments are going to want to have control, but many of the entrepreneurs are going to want to keep it decentralized, right?
Well,
this
is the other battle, because you say that they want to keep control, but Jamie Dimon doesn't want his banking network to become irrelevant. They're trying to experiment with JP coin,
right? I agree.
You've got China saying the government want to issue the digital yuan. So there's a battle between the central banks, the banks, and the governments, and then you've got the decentralized world. So there's four people that are battling out, and money is just, I tell people to think of it like a big swimming pool. There's just, it can wash between these buckets, and I think it's going to eventually go to where it's treated best and there's the lowest fees and where there's the hardest money. So everything that we've just spoken about is all just a stepping stone, because people are still going to eventually realize that there's trillions of liabilities, or there's someone else's problem, even if you have a digital dollar or a digital euro. And then they're going to say, well, Bitcoin or digital gold or whatever it is it's a more scarce asset. If the store of value is the aspect they're going for, not the velocity, means of payment or whatever. Like Bitcoin isn't the best method of that at the moment. But I think if we're going down the hyperinflation path, then people will eventually realize it's no better holding a digital dollar than a dollar. If it's hyperinflation, that's when I want my gold or my Bitcoin.
Right.
Any thoughts on all of that?
Well, so I think listen, this is just, it's such I love this area. I wish I had more time to focus on it, because it's like the wild, wild west, right? It's kind of like pure capitalism right now, but the governments are trying to get in there and regulate it, right? So you've got this, I don't know what's right. It's kind of a mess, but it's kind of cool, right? But listen, traditional banks are not efficient. I think everybody knows that, right? The fact that I think the banks in the last 12 years they've paid like close to $1 trillion in fines based on all the,
laundering,
the laws that are broken and regulations that were stepped over. I think global banks have been fined close to $1 trillion, and yet they're still making money, and they're still and their stock prices are high. Right now, what industry can pay $1 trillion in fines and just write it off? Right, that shows you how inefficient those banks are. Right, so there's no question that these can be done more efficiently.
Well,
and I think the banks are
inefficient for customers. It's very efficient for shareholders.
No, that's what I mean. No, exactly. And so I think, and that is what has provided this opportunity for these, financial digital companies to kind of step into that market. And, the banks tried to ignore it for a long time. And like you said, JP Morgan and Jamie Dimon kind of laughed at it, but it's too big and too powerful for them to ignore. So now they realize they've got to get into it. And it's gotten big enough and powerful enough that even the central banks are like, you know what? We can't ignore it either. So now the central banks are going to want to issue their digital coins as well. I think what I would say is the reason that the opportunities are so big is because it's incredibly risky. You don't get to have incredible returns without incredible risk. Now, if you happen to bet right, maybe the risk is lower than everybody else thinks it is, and therefore you have an edge and you can make a lot of money on it. But the point I want to make is that this is not an area where the governments and the existing banking system is just going to step back and let the newer entrepreneurs take over. They will fight it tooth and nail, right? Now, that doesn't mean that they're going to win, but they're going to fight it. And I think ultimately we'll end up with some kind of a hybrid between what the market wants and what the government wants.
Yeah. So
the market wants a decentralized world, right?
Yeah.
Right.
So there's three, I guess the final 3 points I want to get into to tie this all together is one, the yields that are on offer, and if that's going to attract more capital, the final destination of what Bitcoin and the properties it has versus if we had to launch some new system and the central banks came together, and as well as the really important one that I want to get into now is everything we spoke about in terms of the QE and the money printing is not inflationary as long as it's just reserves in the banking system. That all changes. It gets flips on its head when we have Fed coin and you download the app and they give it to you. And if everyone gets $1,200 and they go out and spend it, and there's all these farms that are going broke and there's less vegetables out there, we're already seeing inflation. So yeah, that's I think something that I'm very interested to hear your opinion on, and where all these current currencies and governments and central banks or banks like Jamie Dimon coin, they're all wanting to create their own coin and their own app and give it to people, and that is very different to having reserves.
I absolutely agree with you. And and MMT in general, this is a very broad statement, and I know people will listen and say that's not the way it works. And okay, fine. There's many different ways that this can work, but in just a very general sense, central banking controls monetary policy by setting the interest rate. MMT, and they loan money into existence. In MMT, it says you don't have to loan money in existence. You can just spend money into existence, and they control it with the inflation rate. Right. And so it's kind of a similar thing, but it's two opposing forces. And so we're also getting into this thing where central banks aren't going to want to give up. No institution ever wants to give up control. Yeah. So, we've kind of get this merging of central banks and treasuries, and, fiscal governments are going to start doing fiscal spending, which kind of starts to take monetary policy away from the central bank. So there's going to be this battle between treasuries and central banks, and they're probably going to end up merging in some way. And then you've got battles between central banks and the market. They want centralized control, and the market wants decentralized. And in between the two of those is the commercial banks, who they want but it's all going digital, right? So the thing that they all agree on, I think, is that it's going digital. How it gets expressed, that's another thing. But to your point, when central banks and when banks or central banks start sending stimulus or fiscal spending directly to the market and it doesn't get clogged in the banking system, that is going to be much more inflationary than what is happening now. I don't think we're there. I don't think we're there yet, but it's coming. And so we will get into periods of very high inflation. I just don't think we're there yet.
Yeah. And in terms of this booming crypto ecosystem, there's some very high yields available. And one of the reasons I think the US dollar has maintained its attractiveness is because you can get 2 or 3% on a treasury bond versus negative in Europe. So people want the US dollars, or the stock market in the US is better. So there's these reasons to be sitting in dollars. Now, there's reasons to be sitting in digital dollars because very easy to get 5%, 10%, or some of the yields at the moment are more risky for some other reasons, but it's just far higher than traditional markets. So in my thinking, it's, again, water finds its level. If people can get, even if $1 trillion floods into the crypto markets, the yields might drop to 4%, 3%, but it's still better than 1%. So I think that that's another reason for people to hold digital dollars and get involved in the crypto world. And maybe there's high yields on Bitcoin or Ethereum, I'm not sure. But all of that, I think, would you agree that it's going to suck money into that ecosystem if you can get a better yield?
If you can, well, there's a reason there's a better yield is because theoretically, at least, there's a higher level of risk, right? I mean, that typically goes along. Now, if those companies can provide that level of yield and over time prove that you're not taking an incremental level of risk, and there's no doubt in my mind. Of course, capital will go where it's treated best, right?
I think in some ways there is more risk, but in a lot of ways it is just the basics of supply and demand. And the velocity of money of stablecoins, there was a report recently, velocity was 20, and the velocity of US dollar M2 was 1. And so you see how quickly things are evolving and circulating in this ecosystem, and that requires a big demand because everyone wants to loan this money and leverage trade or whatever the reason it is. So,
is that a report you can share with me?
Yeah, for sure.
I'd love to read it. I'd love to see it.
Yeah. So that's one thing that I think also plays into this theory. To what degree, I'm not exactly sure. But then finally tying this all together, when I speak to very smart people and they say that we're going to this place where there's a new system or there's a hybrid or everything is going digital, and they keep ticking all the boxes of the properties of Bitcoin kind of without realizing it. And they say, but it won't be Bitcoin, or they won't allow it. So if you were to describe the properties of, well, it has to be apolitical, censorship resistant, it has to be finite. So there's one country that can't print more of it. Do you see where I'm going? That like Bitcoin there's the reason that it's gone from this tiny currency to a couple of $100 billion. And I think it's going to go to a couple of trillion in the next couple of years. And the reason I think that those returns were so big was because all the big money missed it. It didn't go through the traditional VC route or banking route. Yeah. Everyone wrote it off. And that's why it is just making its way to this market cap where it's going to compete with Forex reserves, gold, whatever. So what are your thoughts on all that?
Well, so I think you're going to love talking to Raoul Pal because, I mean, he agrees with you. I mean, he thinks it's the greatest asset in history,
we talk about it every second day, Raoul and I, on WhatsApp.
Oh yeah. So, listen, I'm actually a big fan of Bitcoin. I think the likelihood of it going much higher in the future is extremely high. I think there's more risks involved in it than some people do, but I think if you have a portfolio that has some space in that portfolio for some asymmetric returns
1%,
or some kind of
something like that,
speculative asset, to not have 1% it's kind of foolish just because the upside is so big. Now that doesn't guarantee it's going to pay off.
Yeah.
I'm just saying, like, there's no other asset out there that has the same level of upside as Bitcoin.
I think it's a call option against. It's almost like back in the last 20 years, 30 years, there was these cycles, and you rotated out of stocks and you went into bonds because you wanted to go risk off and still get some yield. Whereas now everything is kind of changed. There's no real yield in bonds, and the buyer is just now the central bank. And now we're in these currency wars, and it's almost like you have to stop thinking about those things as having those traditional inverse relationships or whatever it is. And it's just like the financial system, like currencies, the fiat world, the legacy system versus this new system of scarcity. And I think gold kind of is the same play, but it's one or the other. Like everything is going to be diluted. On how do you not get diluted? I think that's just the question you're trying to answer and protect your wealth.
Yeah, I mean, listen, I'm somebody who I kind of think the whole gold versus Bitcoin debate is really silly, because you don't have to own one or the other. You can own your 10, 15, 20% allocation of gold and still have 5% allocation to Bitcoin. Or, some people have a lot bigger allocation. Maybe they have 30%, 40% of their money to Bitcoin. I don't think you have to choose between the two. Yeah. I think for whatever reason, this world gets boiled down into this versus that.
Yeah.
And the great thing about the world is you can own both. But even if gold went up 10 times from here, that's a $25,000 gold price. Bitcoin could go up 100 times from here or 1,000 times from here. So I think it doesn't mean that gold's not going to do fantastically well. I just think that the ultimate upside for Bitcoin is potentially higher than it is for gold. So why not own both?
Oh, yeah.
Right?
And I've been a big fan of both for many years now, and saying that the big money, the pension funds with hundreds of billions and trillions of dollars, they can't park in Bitcoin. We've seen it in the last month. We've had pension funds come out and say we're getting a higher allocation to gold and we want to get defensive.
Yeah.
Just, I guess, wrapping it all up, I think for me, watching very, very smart people that understand the banking system intricately, like Lynn Olden, Jeff Snyder, yourself, and these people that are, it's like the new wave. This is the biggest cycle that Bitcoin's going into.
Oh, yeah.
It's not just, crazy guys on the internet or cypherpunks or retail speculators anymore. It's people that understand every aspect of the financial system saying, Bitcoin's fundamentals are bullish with what's happening in the macro environment.
Yeah, I agree. I mean, this is going to end up with digital central bank coins. Now, whether Bitcoin sits alongside of them and it's just, it's like an international currency of its own, alongside a number of other, central bank currencies. I don't know exactly how it's going to play out, but there will be a new system that's introduced sometime in the next decade, I think.
Yes.
And I think when it's introduced, it's going to be digital.
And there was a report out this week saying Bitcoin's already the 6th largest currency by market cap. So when people say they'll never let it happen, it's already past 170 currencies. So now it's dealing with the big boys, though. That's slightly different. But look, I've really enjoyed that, Brent. I think we could go into so many rabbit holes about digital coins, but we've gone an hour already. So I really appreciate your time. I'll put all the links to follow Brent down below. Any final thoughts for people?
No, I just think, listen, guys, this is, whether my theory ends up being right, I think it will be, but it's a crazy world. Anything can happen. Whether your theory ends up being right, I don't know, but anything can happen. I think the most important thing is to keep an open mind, be ready for anything. There's nothing new under the sun, so to speak. Like all of these games have been played before, just on different scales and in different time periods. But we are witnessing kind of a changing of the guard, for lack of a better word, right? Both on a geopolitical perspective, on a monetary perspective, on a social perspective. I mean, I think the next 5 years are just going to be, historical on so many levels. Yeah. And I think I would encourage people not to say that can't happen, because it can, right? Can the dollar go to 50? Yeah. Can the dollar go to 200? Yeah. I think you got to be ready for both.
I think 2020 has really proven that anything can happen beyond a shadow of a doubt. But appreciate your time, Brent. That's been absolutely brilliant. We'll have to do part 3 in a few months or a year. But I hope you guys have enjoyed that home. So cheers.
Yeah, happy to do it.